Ever wondered why price reverses at certain points, or why a sudden spike happens like this one over here? It's because big institutions are at play. Welcome to today's video, where we will dive deep into one of the most powerful concepts in trading: order blocks. Understanding order blocks can help you trade like the pros and spot those high probability setups that provide high risk reward ratio, like in this example. For example, this trade provided almost 4% return. What is an order block? An order block is a price zone where large financial institutions place bulk buy or sell orders. So there are two types of order blocks. The first type of order block is bullish order block, and the second one is bearish order block. However, for this video, we are going to focus only on bullish order block, because the bearish order block is just the opposite of a bullish order block. So let's get going. So what's a bullish order block? A bullish order block, it is the last down candle with a down close. That means it closes black, or what matters, it should close as a sell candle. The color doesn't matter, it can become red, I don't know, but what matters is it should become a sell candle, and it should have a big range. And the other thing is that it should not be forming in anywhere on the chart. It should form on a support level, like in this case. This is a large range candle that forms on a support level. So we have a large range candle. Now what's next? When does it become an order block, or when does it get validated? So we wait for the high of this sell candle to be traded above by a later formed candle. So this is what happens. So this last candle has been formed, and then this candle trades above it, and then we wait for price to return to the high of the order block. So the high of the order block is actually your point of interest. So here is our first example. So what did we say? Before you anticipate an order block to form, the price has to come to an institutional support or any form of support. In this scenario, the price has come and cleared this loss. And then what do you wait for next? A big range candle to form. That's a downward candle or a sell candle. It has been formed over here. Okay, excuse me for that. So this candle has been formed that has raided this loss. So then what do we anticipate? We anticipate the high of the candle to be traded above by a later formed candle. So let's see what happens in the next candle. Yes, the order block has been validated. So the moment the order block is validated, so what is it that you do? You put your buy limit on the open of the order block, on the open of the order block over here. That's where you set your buy limit. And then where do you place your stop? At the loss. And then you target that high, or you target 1:2. So let's see what happens, or what the price does. Exactly, that's what happens. That is our first example. Second example of the day. So what was our first rule? Our first rule is that the price should come into an area of support. So what do we see over here? The price cleared this sell side liquidity. You see this sell side liquidity, and came into a mitigation block, or you can simply say, retail say that this is a simple break and retest. We have a large range down candle, but for the order block to be validated, the price has to go above the high of the candle. So let's see what happens. Let's mark the high of the candle. That's our point of validation. Let's see what happens. It has been validated. So now what's our next step? We put a buy limit, or we currently buy now. We just put a current market order, and then we target those highs, or a simple 1:2. Where do you place your stop loss? Always below the low. And where do you enter? At the open of the order block. So let's see how these trades play out. That's a clean 1:2. That is what I mean. That price that is in trend and is supported by an order block, that price has a high probability of running into equalize or a drawn liquidity.